Okay, we're going to run CAVA through my stock buying system. So as you know, one of the first things that I'm going to do here, and the absolute most important part of the system, is to run the charts on this stock. So I look at the 5-year first, and over 5 years, this is up 123%. That is beautiful. 1 year, 132%. So this has been on quite a run this year. Gosh, we started at 42 and we're all the way up at 99. Amazing. And then I'm going to look at the 3-month chart, and that is up 29%. So all looks really, really well there. The next thing I like to choose to look at and look for is to see if there's a dividend. And there is not a dividend on CAVA. That means that CAVA is more susceptible to market pullbacks when the market pulls back. Non-dividend paying stocks will pull back harder than dividend paying stocks. The next thing I'm going to look at are the financial statements and look at the total revenue and also the gross profit. And I want to make sure that these numbers are going up every year. And it looks like here on the top line, we're going from 500 to 564, 728 to 784. The gross profit is 82, 97, 180, 195. So those both look amazing. I skipped over one part, guys. I apologize. First thing we have to do is actually understand what CAVA does. CAVA is one of these sort of fast food places where you can come in and get scoops of protein and carbs and vegetables in sort of like a bowl, very similar to Chipotle, very similar price point to Chipotle, and it's growing very rapidly. The thing is about CAVA, it's not everywhere yet in the United States. It's, for example, I don't even know if I live in Chicago, and I feel like we're just starting to get them, but they've had them in the South or some other areas of the United States for longer, because I didn't even know who these people were 6 months ago. One of my traders brought it to my attention. I looked it up then and started researching it more. So that is what CAVA is. The second thing that I'm going to say here is that these numbers, if you look at how much money is on the table here and how much money this company is pulling in, this isn't the same as a Chipotle. So let's just go over there and compare the sizes of what these two companies are bringing in. Do you see the difference? It's a big difference. So this gives me a little bit of pause. This gives me some pause. This tells me, hey, this company is newer. Perhaps we are going through a big growth spurt. Perhaps this will continue to grow, but I don't really know. And being that this company is younger, newer, etc., like it's not somewhere where I want to park a lot of my money, because I don't know that it's as tried and true as sort of like a Chipotle Mexican grill would be. Because Chipotle, again, when we look at how much money they're bringing in, you can just see it's a much, much bigger company. The thing that I think that is also just very intoxicating looking at this company, or very interesting for me as an options trader, is that the call premiums on this pay a lot of money. So the first strike price that I would sell for a covered call would be the 102 strike, and that brings in $580 in premium for a 3-week covered call. So that's kind of what makes this stock interesting for me as a covered call writer. But I just know that when I enter this stock, there is more risk of this stock going down on me over time than there is on a Chipotle Mexican grill, just because the company is newer, is not as tried and true, and just doesn't have the kind of revenue and profits yet that a Chipotle Mexican grill has.